Have you ever considered how multi-residential investments can act as a stable alternative in the real estate market? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. At the 2025 Endowment and Foundation Investment Forum, Alexandra Katz, managing partner and head of institutional relationships at Hazelview Investments, highlighted the growing opportunities in Canadian multi-residential investments. According to Katz, these investments provide stability over time and offer downside protection due to their counter-cyclical nature and a diversified tenant base. While other real estate sectors may be impacted by behavioral trends, the consistent need for homes ensures stability in multi-residential portfolios. Institutional investors are finding that they can achieve predictable cash flows from this asset class, providing a reliable income stream. Katz also emphasized the significant exposure to environmental, social, and governance metrics within multi-residential investments. The social component is particularly important, as investing in multi-residential properties means investing in communities that need more homes. When you're thinking about somebody's home, it's not just about an investment, it's about where people live, Katz explained. Understanding the nuances between different submarkets across Canada is key to adding value that resonates with residents. The Canadian multi-residential market is poised to benefit from favorable supply and demand dynamics. Immigration patterns have been a significant driver, with Canada seeing a peak of 1.2 million people entering the country in 2023. This surge has driven up demand for rental units. Katz noted that while population growth is expected to decline due to changes in Canadian immigration policy, the market is likely to stabilize, giving it a chance to catch up with the demand. Furthermore, several factors are supporting strong sector fundamentals. Home ownership declined by 2.5% between 2011 and 2021, indicating a growing demand for rental units. Demographic changes have also led to longer average rental periods, adding pressure to the rental pool. On the supply side, rising construction costs, which have increased by about 45% since the coronavirus pandemic, present challenges. In a softer economic environment, fewer people may feel they have the flexibility to buy homes, further driving rental demand. Katz anticipates that supply will decline from 2027 due to slower construction starts, setting the stage for strong risk-adjusted returns in the multi-residential sector. This presents an opportune time for investors to delve into multi-residential investments, capitalizing on these dynamics for potentially lucrative returns. Banner Real Estate Group has recently broken ground on their multifamily development site, the Faywell, located at 220 West Liberty Drive in Wheaton, Illinois, directly adjacent to the Metro Union Pacific West Station with service to downtown Chicago. This marks a significant milestone for both the firm and the city of Wheaton. The Faywell is set to become a 334-unit Class A multifamily community that combines high-quality residential living with thoughtful design and amenities, integrating seamlessly into the surrounding community. This project, nearly 5 years in the making, will feature a resort-style pool, a state-of-the-art fitness center, a co-working lounge, ample bike parking, and direct access to the DuPage County Prairie Path, one of the region's popular recreational trails. The ground floor retail space will host Egg Harbor Cafe as the anchor tenant, a beloved local establishment returning to its original Wheaton roots. Bob Flannery, Chief Executive Officer of Banner Real Estate Group, expressed excitement about bringing the Faywell to life as a best-in-class residential option. He highlighted the location's vibrancy, charm, walkability, and the convenience of the Metra commuter station. Flannery emphasized that this development represents not only a significant investment in Wheaton's continued growth, but also a long-term commitment to improving the quality of life in the community and contributing to the vibrancy of downtown Wheaton. Key partners in this development include institutional investor PNC Bank, JLL, WA, Randolph, Incorporated as the general contractor, BKV Group for Architecture, and CAGE Engineering Incorporated. Banner Real Estate Group was founded in 1989 and is based in Chicago. The group, which is family-owned and independent, focuses on acquiring, managing, and developing multifamily properties, self-storage properties, and industrial properties across the United States. Since its inception, Banner has maintained a focus on capital preservation, value creation, and wealth generation for high net worth investors, family offices, and institutional partners. This latest development of the Faywell is a testament to their commitment to these principles and their dedication to enhancing community living through thoughtful and strategic real estate investments. In a noteworthy development from the Boston Real Estate Times, Newmark has secured a significant refinancing package totaling $143.1 million for the Fairways, a large-scale multifamily property located at 1 Forest Ridge Road in Derry, New Hampshire. This financing initiative marks a strategic move for the property's owner, Maker Capital, which has a notable presence in the New Hampshire and Massachusetts multifamily markets. The transaction was arranged by Newmark Vice Chairman Ed Bells and provided by Fannie Mae. Bells emphasized that this deal enables Maker Capital to unlock built-up equity in the property while maintaining ample liquidity for ongoing and future initiatives. According to Bells, Newmark and Fannie Mae were able to deliver an extraordinary execution, allowing Macor to distribute a portion of the built-up equity at the property while also retaining significant liquidity to execute its business plan and maximize the long-term potential at Fairways. This refinancing package reflects a long-standing professional relationship between Newmark and Maker Capital's founder, Chris Wyett, which has spanned over 2 decades. The package features a 10-year loan term with full-term interest-only payments, a 35-year amortization schedule, and an early rate lock, capitalizing on a recent decline in interest rates. Maker was able to lock in the rate within 3 weeks of applying. Chris Wyett, who acquired the Fairways in late 2016, described this refinancing as a strategic move. Fairways has experienced a substantial increase in value since we acquired the asset in late 2016, said Wyett. By refinancing, we take some chips off the table while we continue to own and further improve the property over the long term. Maker generally has a long-term perspective provided we continue to see value potential and stable yields. Constructed in 1984, the Fairways spans 108 acres and includes a mix of 2, 3, and 4-story residential buildings. Situated along Route 28, approximately 3 miles from Interstate 93 and less than 10 miles from Manchester Airport, the property offers a variety of amenities and has become a key asset in Maker's growing regional portfolio. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.